So today's Cardinal lesson, we're comparing a traditional long-term care insurance policy to a hybrid life long-term care insurance policy. Two different ways to solve the problem, different expense associated with it, but yet similar benefits between the two policies. So what you're buying it for is long-term care protection, and just how you pay for it and what it gives you back, that sort of thing are different. So this is a good opportunity to learn about both of these today. I want to push it to Tom, and I want Tom to share, why are we doing this today?
Yeah, I mean, we're doing this video because long-term care planning is the most impactful thing we do here when we're planning for your future. Of everything we handle, which is a lot, investments, Medicare, Social Security, all those things, this is the one thing that if it happens, will upend your life, your family's life, and your loved ones. I mean, this is the thing that really causes a lot of plans to fail, and you need to plan for it. If you've watched this channel, you know a little bit of my history, but I have an autoimmune disease. Back in 2018, I ended up in a wheelchair. I was in my 20s. I ended up in a wheelchair for several months. I was in the hospital for about a month. And it comes out of nowhere, right? You never plan for it. You never think it's going to happen to you. And again, you just don't know until you know. And at that point, it's really, it changes everything. It causes a lot of issues within family, because who ends up bearing the burden of this is your loved ones, right? It's your spouse if you're married, it's your kids, it's people who have to pause their lives to take care of you. And the insurance that we'll get into here in a second, that is the thing that helps fund the care, and it removes one stressful piece of that, is how do we pay for this care? It's still going to be stressful when it happens, right? It still changes everything. It upends your life. But if we can have planned for one aspect of it, I think it makes it a lot smoother. So let me bring up the show notes. Again, you can find these at the link below our video. They're also on our website at cardinalguide.com. We have the board as always. And then again, we have the illustrations. All the numbers that are on the board are represented in these illustrations here. The first one is the left side of the board. It's Mutual of Omaha. This is the traditional long-term care. And then once you scroll through that, you get to Nationwide, which is the hybrid policy we're going to compare it against. That's on the right side of the board. Watch the video first, but once you get a little bit more context, go back and you can find all the numbers that are on the board represented in these illustrations. So let me turn it over to Hans, and we'll get going through sort of these two examples.
Okay. So as I said earlier, the traditional long-term care policy, which is in the show notes, the illustration for it, pays out similar benefits to the hybrid life long-term care policy. And so what you're going to get is, if you bought this policy, two people age 65, a couple, and so if you're younger than 65, you can deduct some from the premiums that are showing up here. If you're older than 65, you can add some. But this stuff is available much past 65. And so what I want to show you is both of these policies pay similar benefits. So if you used it right away, it's $6,000 a month, $72,000 a year, and it's got a maximum of $288,000, which adds up to 4 years. So you could go in an assisted living, go in a nursing home, use it at home to the tune of $6,000 a month, and you would be paid for that, reimbursed for that by the insurance company. If you didn't use the whole $6,000 in any given month, that would stay there in your bank, so it would last longer than 4 years. And that's true with both policies. Now, what's also here is these are shown and priced as a couple, and this one has shared care. The traditional long-term care has shared care. This policy just has an overall maximum that either spouse can use. So it really makes the maximum of this policy at age 85 of either policy a little over $1 million. So meaning that if one spouse gets sick, uses the care, they use it for 4 years, and then you think the care is running out, they can dip into the other spouse's benefit and use it all the way up to over $1 million of benefits. So it's a pretty good maximum benefit. So it has a 3% compound inflation. So by the time these people are both 85, it's 10,837 a month is the benefit. That's 3% compounded to 6,000 for 25 years. Excuse me, for 20 years. And so those are the benefits. Similar, not exact, but similar. So I want to talk a little bit about the price of this policy and how you pay for it and the price of this policy. So with the traditional long-term care, first of all, you're going to pay, this couple is going to pay $9,396 a year. Okay. And you could pay that by the month. You can pay it semi-annually. You can pay it by the year. Total of $9,396 a year. And that premium is for life. It's just like any other insurance policy. You keep on paying it. Where it's different is once you start using it, the premium goes on waiver of premium. Once you've used it for 90 days, then they're going to stop sending you premium for either spouse. And so that's a benefit to that. But this premium is continuous. It's going to go for the rest of your life. Now, over here on the hybrid life long-term care, you have the option, first of all, of paying a single premium, which would be $205,000. Now, remember, that's covering two people. Now, you could pay a single premium. You could do a 5-pay premium, which would be $44,577 a year for 5 years. Same thing with a 10-pay would be $25,000 a year. And a 20-pay would be $16,000 a year. Okay. And the difference between this premium and this premium over here on the traditional is these premiums are guaranteed. They're never going to change. Okay. It's backed up by the insurance company. They can't send you a premium increase. This policy could have a premium increase. It's priced to not have one. And to get one, they got to go through some real hoops with the insurance department and prove that they need it. So there's a bunch of new rules that have been put into place in that, but it's still, the insurance company could raise the premium. So I want you to know that as a difference. So the purpose of giving these prices is just to give you somewhat of an idea of what kind of money we're talking about here. Now, we have a lot of different ways, like I said, to pay this, especially over here. We have policies, not this one that we're illustrating, but we have policies where you can use IRA money, and we can take a part of your IRA, put it with the insurance company, and then deplete it over 10 years. We also could do one of these 10-pay or 5-pay, 10-pay, or 20-pay, where we're just leave your IRA money right where it is, or you have us invest it for you, and then we're going to just take a distribution from that over a period of time and pay the taxes. So there's a lot of flexibility, and it really requires financial planning to plan for this. And that's kind of all of what we do. But what I wanted to do today specifically is show you the difference between these two, because a lot of times people are buying this, but they don't yet understand this. And so I find myself, Tom finds himself sitting down with clients, on the Zoom, and the very first thing is we're giving them is a lesson in the difference between traditional long-term care and the hybrid life long-term care, or perhaps the annuity care. And the differences are quite a bit, but a basic traditional long-term care benefit-wise is baked into one of these things. So you really need to understand this one before you can understand this one. So I want to bring Tom on, and I think before I get into some details, Tom, do you have some comments?
Yeah, I think one of the things to note is the premiums we have on the board are specifically for a couple who are both 65. So if you're older, it's going to be more expensive, or if you're younger, it could be less, right? It just depends on there. On the Mutual of Omaha one, we ran them at the preferred rate, which is sort of their best rating class. It could be more expensive if you come back at their standard rate, or they even have ratings there. Similar with Nationwide, right? So there is an underwriting component to both of these policies, is you have to be healthy enough to qualify. And again, that's one of the areas that I see people miss and say, I don't need it now. I'm healthy. I'll wait to the future. I'll get it later. And then if I get a call out of the blue, someone I've talked to this about, and they're calling me up, let's say 6 months, a year later, unprompted, first thing that jumps to my mind is there's probably been either an event with a loved one where they've seen what this looks like and now they want to plan for it themselves, or more often they've gotten sick or they've gotten some diagnosis that really makes them start thinking more heavily about this. And sometimes that diagnosis might prevent them from getting it in the first place. So you really need to plan for this while you're still healthy enough to qualify and you can get the benefits. And so that's just one of the points that I want to make. Like, for example, like if I went to apply for these right now, I would have a tough time getting it. Now, again, when you're 25, when I got sick, there's no way you're thinking about planning for long-term care. Most companies wouldn't even sell you a policy at that age. But it just illustrates you could have something happen that really prevents you from getting it. And so you want to think through that. You want to plan for this while you still can. And the real cost of waiting is, yes, the price goes up, but the real cost of waiting is the underwriting piece of it. Is, do you wait too long where you can't qualify? That can be a real issue there. So I want to make that point. I know Hans is going to get into comparing them side by side a little bit more in depth here in a second. But I think that that's something to understand. And to his also point with the Mutual of Omaha is if you start Googling on the internet about long-term care and trying to find people's experiences with it, a lot of people in the past have had really large rate increases on the traditional type of policies. That's one of the big knocks that people have against it. Maybe your parents have been through this and the prices increased drastically. And there's a lot of reasons for that. We don't really want to get into all that on today's show. But like Hans mentioned, the pricing now, it was priced in at that point, but they were making bad assumptions. But now they have better data. The actuaries have better numbers. They can more accurately predict what the cost of this care is going to be. And so the price is priced to stay level. It's not set to increase. Like health insurance, for example. Health insurance goes up every year as you get older. Long-term care isn't going to go up every year. However, the long-term care, the traditional long-term care, they do have the ability to raise the rate if they jump through those hoops, if they can prove to the insurance department that they need to stay solvent and all that stuff. So that's one of the areas that's a big difference between the traditional and the hybrid. Doesn't make the traditional bad. When we compare the costs, it's still the least expensive way to get the care, but you are just truly covering the care need. There is no life insurance component. Nothing comes back to your family if you don't need care. And again, we'll get into those differences here in a second. But I just wanted to make that point. One more, and then I'll turn it back to Hans. Is when you look at the price on the traditional for the male and the female, the total price is $9,396. The male is $3,453, and then the female is $5,944. You start looking at that, it's pretty drastic how much more the female is compared to the male cost. This is really the only type of insurance that they charge women more for it. You know, think about life insurance, men cost more, health insurance, men cost more. Long-term care, women are more expensive. Again, just statistically, women need more care. They need it for longer than men do. It doesn't mean that men don't need a plan for it, because certainly a lot of men do need this type of care. But that's just a unique thing that you'll see is there's a pretty big difference between covering a woman from caring and what it costs to cover the man.
Yeah, while you're on that, I mean, I put that breakdown up here for a reason. Is so the premium is going to be exactly $9,396 at a standard rate a preferred rate for a couple age 65 each. But the breakdown of that premium, just as you saw, almost $6,000 for the lady and about $3,500 for the man. Now, if you are single, or your spouse has got insurance somewhere else or doesn't want to buy it, or they're uninsurable, we run into that, but you want to buy it on yourself, the premium is going to be pretty close to this premium because this thing includes a spouse discount. So that makes it lower, but it includes shared care so that either spouse, if they buy this policy, can dip into the other spouse's benefit if they run out of their own. So say they're in there using care for 6 years and they've exceeded the 4 years, there's a charge for that, and that's built in there. By the time you remove the shared care cost, but then you add in the spousal savings, those premiums are going to be pretty close. And if we go over here and do the same thing, we have a single premium of $205,000. About 50% of that premium will buy the male a similar policy just on his own. And about 65% of that 200,000 will buy the female a policy on her own. And we could kind of get complicated. Is we're not actually recommending that you buy this amount of insurance. We're just simply trying to show you what we go through in pricing the thing. And we're not going to make a recommendation of a long-term care policy until we get your whole financial picture. And we're not going to charge you for a whole financial plan to do that, but we want to make sure you can afford this thing and that you're properly insuring yourself. And then, we sell these all the time to single people. And they're, so anyhow. Now, the differences between the two is, for starters, traditional long-term care is reimbursement benefit. And what a reimbursement benefit means is, let's say you bought the policy and very quickly you needed home health care and you had them coming in 7 days a week for 4 hours a day. And that's not going to cost you $6,000 a month. Let's just say it costs you $3,000 a month. Well, under the reimbursement policy, you're going to get $3,000. Under the cash indemnity policy, you're going to get $6,000, even though you only spent $3,000. So the cash indemnity pays its full stated benefit during any month that you need care, whereas the reimbursement policy is only going to reimburse you for the actual expenses incurred. So big difference. With the traditional long-term care policy, you have no death benefit, meaning that, if you don't use it for long-term care during your lifetime, there's no refund or there's no money going back to your heirs. And people will say, well, why would I want that? I mean, I'm just paying in money that's going to go to somebody else. Well, maybe. And somebody else's money might go to you if you have a big long-term care claim. I mean, that's the whole insurance principle. And what I will tell to you folks that say, well, I'm self-insured, I'm self-funded. Well, if you look at it, you have fire insurance on your home and homeowners insurance that's been going up lately. I know because mine has. Couple $1,000s a year that you're paying, and you don't expect anything back out of that after you pass away if you've gone 30 or 40 or 50 years without having an insurance claim. Furthermore, if you're well off enough to pay a long-term care claim, you're well off enough to replace your house if it burned down or it was injured by a storm, but yet you still have homeowners insurance. And I think people go without this stuff, and we can get into that in some other videos. They say they're self-insured, but what they really are is they don't think it's going to happen to them. And I can tell you, if this does happen to you and your family, even though you got lots of money and you could pay for it yourself, your family is going to be real glad that you had this thing, because it's just going to take money off of the table, at least for a while. And, your loved ones may not be as savvy at accessing your money in a tax efficient way as you are. So I don't want to get rambling off about that. So there is no life insurance on this. There is no refund for not use at death. It's just, this is pure insurance. And over here, the whole idea is it's a life insurance policy that covers two people. Okay. So it's going to pay off the $216,000 when the second one dies. So, and if you use it for the long-term care benefit, let's say you started using it at 85 and you were just one of you is using it. The other one passed away and never used it. And then just the survivor starts using it at 85 and they use it for 6 months and it pays $10,000 a month, or it pays $60,000 in long-term care claims. Then they pass away. Well, then the life insurance benefit at the second death is going to be $216,000 minus the $60,000 it paid out. Or I'm guessing that is $156,000. Yeah. So any claims paid out are going to be deducted from the death benefit. And then if you use it to its fullest, or you use it, there's still going to be $21,600 of life insurance paid at the second day. So there's going to be something coming out of the policy as far as life insurance goes. That's called a residual benefit. So the life insurance benefits of this are there for the people that say I'm self-funded. Well, okay, if you're self-funded, if you have $200,000 set aside to pay for this and you're self-funding because you really can't touch that money. It needs to be there and you're going to grow that money. But what you're buying with your $205,000 of premium is over $1 million worth of coverage in the long term. And so, first of all, this is going to be more the long-term care. And then if you don't use it, like you had the homeowner's insurance for all those years, and you didn't use it, there was no fire, and then, your 200,000, 205,000 plus a little bit is going to go back to your estate anyhow. So you've essentially lost the interest and the growth off of that money. That's paid for the insurance. So over here, you've got a possible premium increase, and I don't think that's real likely. What I can add to what Tom said earlier is, $3,000, $4,000, $5,000 is about what I would have been charging 20 years ago for this same type of policy on two people 65. And that premium now is almost $10,000, $93, $96 a year. So those old policies that had those big rate increases, they were a lot less than this to begin with. These things are priced properly now. Which of the two do we sell more of? It's going to be this one. So, and I did want to bring in the option to not pay the single premium. I mean, not everybody's got $205,000 laying around that they can, after taxes, they can put into paying for long-term care, or $100,000 or $130,000 for singles. So you've got the 5 pay, the 10 pay, and the 20 pay options, and there's other options in between that. So when we have a lot of tools that we can share, and I'm going to talk about a couple other options with long-term care, but I want to bring Tom back on and see if he has more comments about the comparison.
Yeah, I mean, I think the hybrid policy, there is a death benefit. It's a nice feature. It's not the primary reason we're recommending it, right? If you looked at the death benefit compared to the premium, it's not that much more than what you put in. But what's nice about that is essentially it's returning the money you put into that as a return of premium, if you will, tax-free back to your beneficiary. So it doesn't feel like money has just been spent and no one gets any benefit from it. I mean, at the end of the day, I think Hans is exactly right. The reason a lot of people don't plan for this, or they might say, I'm self-insuring, self-funding, whatever they want to call it, is they really just don't think it's going to happen to them. I mean, if you knew 100% you were going to need care, you would buy the largest policy you could get, you could, qualify for, because getting the leverage from the insurance company is better than spending dollar for dollar out of your investments. I mean, it just is. And so at the end of the day, people don't plan for it. One, because they don't think it's going to happen. And they say, well, if it does, I have enough. It's really just ignoring the problem. And again, I've been through it. I've lived through what this looks like personally. I mean, it was super stressful. On me, I was sick. I couldn't walk. But really, who bared the burden of it, and who would bear the burden if you were to get sick, is your family, right? My wife had to step up. She had to take care of me. She had to take care of her 8-month-old child at the time. She's trying to keep the household running. All I had to do was just focus on getting better, which is, I don't want to minimize that, but it was much harder on her in a lot of ways than it was on me. And that's what we see day after day with families coming in. Their loved one is sick, and it's the family that's the one that bears the burden. I mean, I can't tell you how many times I've had someone sitting across the conference room and they're in tears, just the stress that they're going through, what they're, having put their lives on hold, taking care of mom or dad. And it is just really, really difficult. And you don't know what that looks like unless you've been through it or you've seen someone go through it. And that's why we feel passionate about planning for this. Because again, it's super important that you have something there. Like Hans mentioned, the hybrid policies is what we mostly sell. Sort of by default, just the people we're dealing with have the money that can afford to do something like that. And it's nice knowing that if I don't need it, which I guess is kind of the goal, right? I hope no one ever needs any long-term care. But statistically, realistically, there's a good chunk of you that will. And what's nice about the hybrid is at least someone's going to get some benefit of that. Even if it's not much more than you put in, it doesn't feel like you've just spent money on something that never comes back. So not to say we don't also sell traditional. Certainly we sell that too. And it really just depends person to person, what they're looking for, and what makes the most sense for them. And again, it needs to be part of a larger plan. If we are recommending a long-term care, it's never just going to be that we start with that and don't look at everything else. Because at the end of the day, it does need to be affordable. It needs to be part of a plan where you can pay for it now, but also could you pay for it in the future if we're doing some type of continuous pay. And again, all of that is just built in as part of the plans that we do.
Okay. So, in terms of comprehensive financial planning, the Social Security check is the first check for people that don't have insurance that goes toward paying the bill for the assisted living or the home health care. Medicare pays very little for long-term care. For custodial long-term care, they pay nothing. This whole video has been about long-term care. The 401k and IRA money, when we have, as an example, two people age 65, this is where the bulk of their resources are with a lot of people. And so we're going to need to go and include the IRA 401k money in a way to finance the purchase of a hybrid long-term care. We haven't talked really much about income, but it's going to throw your income if you're in a care situation and you're having to pay for it yourself. We're going to have to create a bunch of income right away. Estate planning, we've talked about that in the sense of the refund on the hybrid life long-term care policy if you don't use it. And really taxes, we haven't mentioned this, but the benefits come out of these long-term care policies. You don't have to pay taxes on them. And if you self-fund, you're going to be paying with after-tax money. I mean, there's some ways we could go in and help you plan for that and deduct some of those expenses, but just keep that in mind that the benefits coming out of a long-term care policy to pay for care, you don't have to pay tax on that money. So with that, I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.